Good evening, everyone, and welcome to our income-driven repayment workshop. My name is Natalia Abrams with Student Debt Crisis Center. And while folks are joining, we're just going to go over some quick things. So, as I mentioned, I'm Natalia Abrams. We are Student Debt Crisis Center. We are a national advocacy organization with nearly 2 million supporters nationwide, calling for fundamental reforms to student loan policies and an end to the student debt crisis once and for all. We want to give a special shout out to our funders for these workshops at the Annie E. Casey Foundation, and we thank them for their support. However, always to clarify, the information presented in this workshop is that of ours at SDCC and does not reflect the opinions of the foundation. So some quick reminders, general housekeeping for you all. Please use the Q&A function on your Zoom. Our chat is disabled, and so we do not answer questions via chat, but we will answer your questions to the best of our ability through the Q&A function. We have Sabrina, Ashley, and Angel all here to try to answer as many questions as possible. Any information shared on today's clinic, so what we're sharing with you today, can always change. So this is as of March 25th, 2026. Just important if you're viewing this weeks from now to check the current news. A recording will be provided for anyone who has registered for this workshop. We get that question a lot, so you will receive a recording and some helpful information about 24 hours after the end of today's workshop. So today we're going to cover all things income-driven repayment plans. So identifying your repayment goal, the basics of income-driven repayment. That's what IDR stands for. So the basics of income-driven repayment forgiveness. What are my repayment plan options and how do I calculate payments? And there are some helpful free tools for you. Updates to the SAVE plan. We know we get a ton of questions on that. So what's going on with SAVE, upcoming income-driven repayment changes, and more. Quick disclaimer, we are not financial counselors or attorneys, but we are advocates and experts here to help you. So let's jump right into federal updates. So last Thursday, many of you may have heard that the Department of Education announced that the student loan portfolio will be moving to the Treasury Department. There are a lot of unknowns here. You're going to hear that when I cover the SAVE program in just a second. We are still waiting to know exactly what this looks like for student loan borrowers, but here's what we do know. We know that defaulted loans are going to be the first moved. The most vulnerable of student loan borrowers, of course, will test out the waters. Something that's only going to add more confusion for folks, but that's the first step. The second step is the remaining student loan portfolio will follow with they are saying that all student loans will be moved to the Department of Treasury. In addition to that, student loan programs run by FSA or federal student aid, such as FAFSA program and Pell Grants, will also be taken over by the Treasury. What this actually looks like, we will continue to update you as we get more information. What we can strongly suggest you do right now, since there are so many unknowns and so many changes going on, is to save and document all of your student loan information. Screenshot, download what you can from your student loan servicer at studentaid.gov. Just keep a copy of your records somewhere safe, so that way when there is a transfer, when something happens, you are able to go back to your own records. Let's continue on with more federal updates. Major changes are coming in July of this year, 2026, as a result of the so-called One Big Beautiful Bill Act, which was the major bill passed through Congress last summer. These changes, which we're going to discuss more today, these are changes that have not been finalized, but are going through a negotiated rulemaking process. We don't expect them to change that much. We do expect what we're going to talk about today of what's proposed to happen by July 1st. We do anticipate the final rule sometime in May, and implementation is supposed to happen July 1st of 2026. These changes include new lending limits, phasing out of repayment plans for current borrowers, such as income contingent repayment, which is ICR, or pay as you earn or pay. Those will phase out actually in July of 2028 or sooner. Limited repayment plan options for borrowers with new loans. So those are loans that you take out after July 1st of 2026. New repayment plans, which is the WRAP and new standard plan, and more. And don't worry, the Sabrinas are going to cover a bit of what these changes are. And as we get closer to the deadline, we will be doing more workshops specifically on the changes to come. Note there continues to be significant backlogs in the application processing and loan discharges at the Department of Ed. All right, so what is going on with the SAVE plan? So there's been a lot of back and forth in the courts, but in just the past few weeks, the Eighth Circuit, which is where the decision making, for the SAVE plan was supposed to happen, ruled and effectively ended the SAVE plan. That it is over, the fight is over in the courts. So now we are waiting guidance from the Department of Education on exactly how 7 million folks who have been enrolled in the SAVE plan are going to move into a different repayment plans or the standard plan. This is another place where we just do not know exactly how this is going to happen. The Department of Ed indicated that they would provide guidance in the coming weeks. That was more than 2 weeks ago. We are still awaiting what that guidance is. What we do know is that 7 to 8 million people are enrolled in the SAVE program, are currently in aid forbearance. That means you've been making no payments, but since as of recent, you are accruing interest. This forbearance can now end at any time because the SAVE plan has been, ruled to be over by the courts. We know that interest started August 1st, 2025. That is not new. Also, it's not new that people can no longer apply for SAVE because the program is now over. Here's what remains unclear. The timeline. When is the Department of Education going to force people out of SAVE? How long will that take? This transition process. Will you need to take action? Will it be automatic? How long will you have to get out of SAVE? How long will it take to process student loan applications? We know that there are, more than 500,000 applications that have still not been processed. We have heard from, other experts in the field that say it could take up to 2 years to transfer all of the SAVE accounts. So as we get guidance on this, trust me, we will be having, workshops and Q&A sessions on the SAVE program as we get the guidance from the Department of Education. But what we are looking out for is the Department of Education to give clear guidance on how people will be transferred out of the SAVE program. So a question we get is, wasn't SAVE supposed to end closer to July 1st, 2028, along with the income contingent repayment or pay as you earn program? Unfortunately, because it was being attacked in the courts, and that has ended it. So it's no longer July 1st, 2028. It's any day now. We're going to get this guidance, and then we will know how the potential timeline, hopefully, from the Department of Education. The OBBA, that bill from last year, stated that SAVE would be phased out. But again, due to that court ruling, it's going to be much earlier than anticipated. So we just want you, the student loan borrower, to be very careful with misinformation. We've heard from loan servicers that they're saying you need to consolidate in order to get out of the SAVE plan. You do not need to do this. This is incorrect information. What you can do right now, just like with the move that's going on to Treasury, definitely document all of your information as much as you can, and then find out what repayment options you qualify for. So there are tools such as the loan simulator at studentaid.gov and the EdCap tool. We will be sharing this and explaining this a little bit more in the coming slides to help you estimate the monthly payment across existing repayment plans. Whether or not you stay and save is entirely up to you. We keep saying this is a personal decision. We know people benefit from not having to make a payment, even though the interest accrues. However, if you are close to the end of your public service loan forgiveness journey or looking to get income-driven repayment credits or close to that threshold as well, you might want to consider switching into another income-driven repayment plan sooner rather than later. And this workshop's for you because we're going to explain what your options are and how to do that. So quickly, I'm just going to remind you all of student loan types, and then I will pass it off to Sabrina. So if you have a student loan, there's federal loans and private loans. Today, we are just going to be talking about federal loans. And federal loans are broken up into direct loans, Perkins loans, and FFELP, or Federal Family Education Loan Program loans. Those FFELP loans are older loans issued prior to 2010. They look like subsidized Stafford, unsubsidized Stafford, FFELP Plus, FFELP Consolidation, and Parent Plus. Those loans can be consolidated to become direct loans, which are direct loans. You can apply or get more generous repayment options with direct loans. And similarly, direct loans are direct, subsidized, and unsubsidized. Graduate Plus, which will be gone after July 1st of this year, and then Direct Parent Plus and Direct Consolidation. Perkins loans are loans that were issued by your school. Those as well can be consolidated into a direct loan and are no longer offered. And with that, I'm going to pass it off to Sabrina Ashley, I believe, to go over student loan repayment options.
Awesome. Thank you. All right, so let's get into all of these repayment options and what we can do. So first of all, with repayment plans, you might have a goal of coming from yourself to pay off the loan or to reach loan forgiveness, or you might not have a goal. And if that's the case, then really the plan that you're enrolled in is going to kind of steer you towards one of these goals. So we're going to go over paying off the loan. So this goal would mean that you're enrolled in the standard plan or one of the fixed alternative plans. And the reason why we say that your goal in these plans is to pay off the loan is because there's no loan forgiveness aspect at the end of these repayment plans. So you are going to pay off the entire balance. Now, on the other side, we have loan forgiveness. And if your goal is loan forgiveness, then this means that you're going to be enrolled in an income-driven repayment plan. So you're going to make payments over time until you qualify for loan forgiveness. So it might help to kind of put yourself in one of these situations, kind of what your repayment plan is, and then also what that means for the end goal of your repayment journey. So the different repayment plans that are out there right now are the standard plan. This plan is a 10-year or 10 to 30-year repayment plan. We'll get into some of those details in a second, but that's basically the plan that you're going to be plopped into when you enter repayment if you don't make any moves to enroll in a fixed alternative plan or a income-driven repayment plan. Sometimes on your servicer website, it can also be called the level plan. So if you see level next to your loans, on your servicer website, that means that you're in the standard plan. Then we have two different categories of repayment plans. We have the fixed alternative plans, and then we have income-driven repayment plans. For the fixed alternative plans, we have graduated repayment, extended repayment, and extended graduated repayment. Essentially, these are all variations of the standard plan, and they are not going to have forgiveness at the end of their repayment timeline. Then we have income-driven repayment plans on the right side, and those are going to include income contingent repayment or ICR, income-based repayment, income or IBR, and there's an old and a new plan or type of that plan. And then we have pay or pay as you earn, and of course the save plan or saving on a valuable education. Two notes here. Not everyone is going to be eligible for the pay plan. And then also, as Natalia was talking about the save plan, no one can apply or enroll in the save plan at this time. Okay, so if you've been with us for a while, you don't recognize this slide. We have tried to visually put out there what loans are eligible for what plans. So hopefully this is really helpful. So we have FELP loans, Federal Family Education Loan Program loans. And these loans are going to be eligible for the standard plan, the fixed alternative plans, and then the income-based repayment plan. So FELP loans are not eligible for income contingent repayment or pay as you earn. Then on the right side here, we have the direct loans. And these loans are going to be eligible for the standard plan, the fixed alternative plans, ICR, IBR, and the pay plan. So you can see the eligibility difference here. And you do have the option to consolidate your loans into a direct consolidation loan to gain access to these repayment plans. So going over a few of these notes here, starting with the income contingent repayment plan and direct loans. A note here about Parent Plus loans. You must have your Parent Plus loans consolidated to access income contingent repayment. You also need to have your Parent Plus loans consolidated and enrolled in income contingent repayment first to then access income-based repayment. And we're going to go over that one more time in a future slide. So I'll say that again when we get there because it is a little confusing. And then for the pay plan, I mentioned on a previous slide that not everyone is eligible for that plan. That's because there's a partial financial hardship requirement here, so not everyone is going to qualify for that requirement. Okay, so a little bit about the standard plan and the fixed alternative plans. Again, the fixed alternative plans are all sort of variations of the standard plan. So the standard plan is going to be a plan with fixed monthly payments based off of your loan balance. We have the 10-year standard plan, which is generally for unconsolidated loans, and then we have the 10 to 30-year standard plan, which is generally for consolidated loans. There are more affordable options for borrowers who are struggling, including these fixed alternative plans and the income-driven repayment plans. So these fixed alternative plans, we have three different types. We have the extended plan, which is going to have fixed payments and a 25-year repayment timeline. It's also only for folks with balances above $30,000. Then we have the graduated plan, which is going to have payments that increase every 2 years. And the timeline for repayment is going to depend on your loan type and your loan balance. And then we have kind of a combination of the previous two. So we have extended graduated plan, and that is going to have the payments that increase every 2 years, but it's going to have a 25-year timeline. And then it's also only available for folks with balances over $30,000. Again, for all 4 or 5 of these plans, there is no loan forgiveness at the end of your repayment. timeline, you are going to end up paying that entire balance once you're done. Okay, so income-driven repayment plans, the star of the night. Let's get into some of this information. So, first of all, what is IDR forgiveness? IDR forgiveness is going to be available to you after you make a certain number of payments while you're enrolled in an income-driven repayment plan. These repayment terms are going to range from 20 to 25 years. We will be talking a little bit about a plan called RAP or Repayment Assistance Plan. This is going to be a new IDR plan that's coming out in July of 2026, and that's going to have a 30-year repayment term. When we talk about IDR payments or monthly payments, qualifying payments, credits, those are all the same thing. So one qualifying monthly payment made in an IDR plan is equal to one IDR credit. An important note here is that you cannot make multiple payments per month to receive multiple credits. And a lot of people on an IDR plan will notice that their balance is ballooning. It's getting larger than the amount of what you borrowed. Especially at the end of that repayment term, you might see a huge balance there. That's because your monthly payments are typically not going to cover the interest that accrues every month on your loan. That remaining balance, though, is what's forgiven. So making an extra payment or a larger payment every month is actually going to defeat the purpose of your income-driven repayment plan, which is to help you make smaller payments in exchange for a longer timeline, and then you get that forgiveness. So just a visualization here at the bottom for payments. If you were to enroll in an IDR plan in January and start making payments of this for this year, then you would have made a payment in January, February, and March, and you would have 3 IDR credits. And then, of course, April, you would make a payment and have 4. So IDR and IBR, a lot of folks get those two specifically mixed up, but we wanted to just clarify what IDR is. So IDR is that umbrella term. It's the income-driven repayment program. Then in that program, we have all of these different repayment plans. So IBR, ICR, Pay, Wrap, and Save are all types of IDR plans. So just as we're moving forward, we're going to be talking about the types of IDR plans, and we're also going to be talking about the overall program, income-driven repayment, or IDR. Okay, so the benefits of IDR plans, there are several benefits here. The monthly payments on an IDR plan are going to be calculated as a percentage of your discretionary income. This means that your payment is based on your income and your family size and not your loan amount. So this is what makes it more affordable than the standard plan and oftentimes more affordable than some of the fixed alternative plans. And with that lower payment, means that you could be preventing yourself from falling into delinquency or default. So specifically, IDR plans can help folks with lower incomes, maybe if you're unemployed or you recently had a decrease in your income. Also, if you have no income or a low income, payments might be as little as $0 per month, which is absolutely a qualifying payment and equals one IDR credit. So you do not have to have an income to be enrolled in an income-driven repayment plan. One thing about the WRAP plan that's coming up is that its minimum repayment or payment amount per month is going to be $10. There is not going to be a $0 monthly payment on the WRAP plan. That is just a new feature on that plan. So just keep in mind that one fact about that. So as you're in an income-driven repayment plan, you are going to need to recertify your income and family size every 11 months. And this is essentially sharing updated information with your servicer so that they can adjust your monthly payments as needed for the next 12 months. We say every 11 months just to avoid any issues with that deadline there. So if your wages decrease or you become unemployed, you can recertify that lower income at any time and you can lock in a lower monthly payment for the next 12 months. So that is a huge advantage of an income-driven repayment plan. If you're experiencing a financial hardship at any time, you can recertify that lower income and get a year's worth of lower monthly payments. One note about forbearances and deferments, these periods generally do not count towards IDR credits. So keep that in mind as you are using those temporary tools to help you along in your repayment journey. Okay, so we've thrown a lot of different plans at you. We've been talking about discretionary income, timelines, credits. So here's all of that laid out for you. You can see we even have the wrap plan on here as well. In this second column, we have the discretionary incomes. These are the different percentages on each of these repayment plans that your servicer is going to be looking at to take or make your monthly payment. You will notice that the wrap plan is a little bit different. That's going to vary between 1 and 10% of your adjusted gross income instead of based off of your discretionary income. That is a big difference. And then you can see that each plan has a different repayment timeline. So it ranges from 20 to 30 years. Of course, the wrap plan is not in effect yet. So as of now, it ranges from 20 to 25 years. And then we have essentially the months or the credits that are required in each of these plans, which are those larger numbers of 240, 300, and then 360 credits. Another reminder here that not everyone is going to qualify for that pay plan. You do need that partial financial hardship. And then if you are a Parent Plus loan holder, you are going to only be looking at these IBR, so income-based repayment lines, and then the income contingent repayment lines as your qualifying repayment plans. Okay, so we've talked about a little bit IDR plans that are phasing out. So what is that going to look like? Basically, these two plans are the pay and the income contingent repayment plans. Folks can enroll and stay in those plans until these plans are phased out, which is by July 1st of 2028. However, they can be phased out earlier if the Department of Education decides so. If you are enrolled in either of those plans and you don't switch to a different plan before they're eliminated, this is what's going to happen to your loans based off of your loan type. So if you have a direct loan, you're going to be placed in the wrap plan. And then any loans that don't qualify for the wrap plan will be placed into the income-based repayment plan. So that's going to include direct consolidation loans containing at least one Parent Plus loan, and then also FFEL loans. So Parent Plus loans are not going to qualify for the wrap plan. And then just a note about these changes specifically, this is all pending final rule from the Department of Education. We, of course, will keep you updated on when that comes out. Okay, so Parent Plus loans. If you have unconsolidated direct Parent Plus loans and you want to enroll them in an income-driven repayment plan, this slide is for you, and you will need to act relatively quickly. So due to all of these changes, Parent Plus loans need to be consolidated, and that consolidation loan needs to be dispersed before July 1st, 2026 in order to gain or keep access to your income-driven repayment plans. So if your loans are not consolidated and like fully processed and dispersed before that date, you're going to lose all access to income-driven repayment plans. So again, if you have unconsolidated Parent Plus loans and you do not consolidate them before July 1st, 2026, you're going to lose access to income-driven repayment plans. This is a ginormous change that is going to be harmful for a lot of folks, and we're definitely advocating against it. But because of this, the recommendation is to apply to consolidate by April 1st, 2026, so that you can get your application in and you have enough time before July 1st to have your application processed and that loan then given to you. Consolidated Parent Plus loans can be enrolled in the ICR plan, so Income Contingent Repayment Plan. And here's that weird thing about income-based repayment. It's new. So if you have a consolidated Parent Plus loan and you enroll in the Income Contingent Repayment Plan, you just need to make one payment in the ICR plan, and then you can enroll in the income-based repayment plan. So it's a little tricky, but as long as you make that one payment in ICR, you can then enroll your Parent Plus loans in income-based repayment. A couple notes here at the bottom. A single application can be submitted to consolidate and enroll your loans in an IDR plan simultaneously. You can do that at studentaid.gov. It says here on the screen for ICR, but that is true for all income-driven repayment plans. You can consolidate and pick your plan at the same time. And then if you have a Parent Plus loan and you know already that they are consolidated and they're enrolled in ICR, or maybe you've already made that one payment in ICR and you've already enrolled your loans in IBR, then this slide does not apply to you. You do not need to consolidate your Parent Plus loans again. Okay, so IDR and taxes. A quick note here. So tax filing, if you're married filed jointly, this is where both incomes are going to be taken into consideration. So when I'm talking about discretionary income, this is the income that they're going to be taking into account if you're married filed jointly. However, if you are now separated, divorced, you can't access your spouse's current income, the Department of Education is not going to factor in your spouse's income or loan debt when they calculate your IDR payment. If you're married and you file separately, that means that your spousal income is not going to be considered. So when your servicer looks at your discretionary income, they're only looking at your specific individual income. IDR loan forgiveness and tax or income tax. IDR loan forgiveness is taxed as income. However, if you did reach the IDR forgiveness threshold back in 2025, and you have your loans discharged this year in 2026, you should not be taxed. This is a relatively new deadline, so just keep that in mind. And then the IRS integration tool has resumed on IDR applications. If you do provide consent, the Department of Education can pull your income information from your last year's tax filing for that online IDR application. However, even though this is an automatic pull for your income documentation, you still do need to manually recertify your income every 11 months. Okay, and finally, what happens when you reach the IDR threshold? I know I saw a couple of comments in the chat already about this. There is no application to fill out once you reach your required number of IDR credits. So once you reach that threshold of forgiveness, you don't need to apply. The Department of Education is going to send you a notice and let you know that you qualify for IDR loan forgiveness. When you receive that notice, you're going to essentially have 30 days to opt out of your loan forgiveness. So if you want the loan forgiveness, you don't need to do anything during those 30 days. But if you do not want your loans to be forgiven, you do need to follow the steps in that notice to opt out of the loan forgiveness. Some people might be asking, why would you want to opt out? The most common reason for opting out is that fear of the tax burden. And then just to make you all aware, we are definitely aware of borrowers who are currently eligible for IDR forgiveness, but have not yet been notified by the Department of Education. This is because Ed is slowly but surely notifying folks and discharging their loans. It could take weeks or even months to hear from them, and this is essentially a direct consequence of the severe backlogs and the lack of staff at the Department of Education. All right, I'm going to pass it to Sabrina to go over how to calculate your payment on all of these different plans.
Thank you, Sabrina, Ashley, and thank you all in the Q&A for your patience as we try and navigate all of this. I'm going to cover, again, how to calculate your monthly payments, and then we also are going to get into PSLF. I know there's a ton of PSLF questions, so please sit tight. We are going to get to that. All right, so as Sabrina and Ashley talked about all of the different repayment plans, a lot of folks are wondering, how do I identify those monthly payments across the different plans? So one of the first options is the loan simulator, which is at studentaid.gov. We're going to show you some screenshots of what all of this looks like in just a moment here. So there's a loan simulator. The second one is you can try calling your loan servicer as well and asking these questions on the phone when it comes to eligibility. When it comes to estimated monthly payments, they should be able to provide those answers for you. And then the third tool here is the EdCap tool, which is another really great tool that folks can use. And it is actually up to date in the sense that it can help you calculate your repayment on the WRAP plan, which is coming in July, and the new standard plan, should you need to use that plan. So there's no guarantees that these estimates are 100% accurate, but they are really great tools for folks considering switching plans. So let's jump into what the loan simulator looks like. So if you go to studentaid.gov and you log in, at that top toolbar, you'll see loan repayment. You can click on that or hover over it, and then you'll see in tools and calculators, the loan simulator. You would click on that, and then you're brought to this next screen here. All right, so on this screen here, our recommendation is that you select the first column. I want to find the best student loan repayment strategy. Once you click on Guide Me, you are then going to see. Okay, so actually before that, you're going to be asked a bunch of questions. You're going to be asked, are you currently employed? Have you filed taxes? Are you married? Do you have dependents? There's going to be a list of questions. Select all that apply, and then you will be prompted to fill in that information, what the income is, what state you live in, how many dependents you have, and then it will ask you on the previous slide here, actually, what your repayment goal is. Our recommendation is that you select the have a low monthly payment, so that what populates is going to be the lowest monthly payment option for you. So in this case, the person selected that they were working towards public service loan forgiveness, wanted the lowest monthly payment, and for them, it happened to be the income contingent repayment plan. That monthly payment is estimated to be $339. The payment period is up to 25 years. I do want to say, and I saw a question in the Q&A here, so I'm sure other folks also have questions. When you see the payment period pop up here of up to 25 years, it's not telling you that you have to work or make another 25 years worth of repayments. When you're in an income-driven repayment plan and you switch from one plan to the other, your IDR credits transfer over. So if you've been enrolled in the pay plan, but now you're going to switch over to the ICR plan, however many credits you had while in the pay plan is going to also transfer over to ICR. So the credits stay the same throughout. So again, this person got ICR. Our recommendation is don't just stick with what it's telling you. Scroll down a little and you'll see that blue button that says view and compare all plans. And once you click on that, you'll then see all of the options that are available to you and what your estimated payment might look like. So in this case, that person qualified for ICR, but then there's also those fixed alternative plans for anyone who maybe doesn't want an income-driven repayment plan and perhaps wants to just pay off the loan through one of those fixed plans. So you'll see that here. You'll also see, if you scroll a little bit down, that it says view ineligible plans, as you can see on the right-hand side here. This person did not qualify for the pay plan because pay has a partial financial hardship requirement, so they didn't qualify. And in this case, the person was told that they don't qualify for IBR, but that is not true. As you see here in this yellow box, the loan simulator is often in flux and being updated. And so it might tell you that you don't qualify. Don't take it at face value. If it says that you don't qualify for IBR, that's just not true. Everyone should qualify for IBR right now. They've opened up the qualification, so everyone should be able to access that plan. So again, this is a screenshot of the loan simulator at studentaid.gov. Now, I think on the next one here, we have the EdCap New York tool. And if someone from our team can please drop these links in the chat, I think that would be really great for folks. For the EdCap New York tool, this is something that can provide more accurate estimates, but it does not confirm your plan eligibility. So if you just want to see an estimate for all of the repayment plans, you can go to their tool and fill that out. And on the next slide is what you'll see. So again, this provided the different estimates for folks. You'll see for IBR, this person was quoted $98 a month. You'll see the percentage of your income, the forgiveness timeline, and all of the notes that you need to keep in mind here. At the bottom, you'll see that there's a new standard plan, which we'll talk about in a minute, and then there's also the wrap plan. I'll also add that these are, again, estimates, and not all of these plans, meaning the wrap plan and the standard plan, the new standard, those are not yet available. And if you do want to enroll in one of these plans, you have to then go back to studentaid.gov, and that is where you can apply for the plan. Going through these tools is not the same as applying for them. You're just getting an estimate. Okay. Again, if you're applying for the plan, go to studentaid.gov. You can do so there. And then what you'll need to have on hand for your application is you need to have your permanent and or mailing address information, your family size information. If you do not opt into the IRS integration like Sabrina Ashley was talking about, you will need to provide and manually upload your income documentation. So you'll need to choose one, so you can use a W-2, a pay stub, an employer letter certifying gross income, a bank account statement, anything of that sort that will document your income. And then one thing that you need to know is you must select a plan. You need to know what plan you want to enroll in. In the past, the application used to allow you the lowest monthly payment option, and the servicer would calculate and just opt you into whatever that would be. That has since been removed from the IDR application. So you need to make a selection. And then something else that I also saw in the Q&A is folks talking about waiting for processing of their applications. It can take anywhere from a few days to weeks to months to process applications. Those applications that are opting in to IRS integration are being processed more quickly. As you submit your applications, you should be placed into a processing forbearance. If you are not, you can call your servicer and demand to be placed into one. That is your right. Also, one thing that we are letting folks know is that if you did submit an application requesting that lowest monthly payment, or you applied for the SAVE plan, or even if you've applied prior to March 2025 and your application is still pending, you'll need to submit another application. If you submitted with the lowest monthly payment or the SAVE option, your application is going to be discarded because those options no longer are available to folks. And then folks who applied prior to March 2025, there's a good chance your application is just lost. So you may want to resubmit. All right. As we're talking about making payments and IDR credits, one question that folks want to know is, how can I find out how many IDR credits I currently have? In the past, on studentaid.gov, there used to be a tracker. That tracker has since been taken off, and so folks don't have that access to that information. So we're going to share a trick here with you. If someone can also drop that in the chat, I'm going to preface this by saying that from the chat, I don't believe that folks can copy and paste. So if you're unable to copy here, that is absolutely okay. We're going to be sending a follow-up email tomorrow where you'll be able to access this trick and this link and use it to find out how many credits you have. So you must be logged into studentaid.gov to take advantage of this trick. So once you log into studentaid.gov, you would copy this link, which is in step 2 here, into a separate tab, into a new browser. And once you do that, it's going to populate something that looks very, very messy. Our recommendation is to select Pretty Print, which we're going to show you on the next slide here to make it easier to read. But if you don't see that Pretty Print, that is absolutely okay. It could be something that is specific to one browser and might not pop up on another. So let's look at the next slide to take a look at what it looks like. So on the left-hand side here, it looks very overwhelming, very confusing. It's a jumbled mess. As you can see, this screenshot specifically has Pretty Print as an option. Once you click on Pretty Print, the image on the right-hand side is what you'll see. And even with that Pretty Print option, it's still pretty confusing for folks to untangle. My recommendation is for folks to look at the first line, which is type. That is where you'll see the repayment plan listed. Then I recommend looking at qualifying count, which is where it lists how many qualifying payments you have or how many credits you have. And then look for forgiveness required payments and forgiveness remaining payments. Now, if we go to the next slide, we have a zoomed in version here where I can show folks exactly what we're talking about. So for this person, if you're looking at the first option, ICR, that person has 54 qualifying payments towards ICR. Now, if we look at the bottom two rows, you'll see that it says forgiveness required payments. That's how many credits are required for you to reach loan forgiveness. Now, because this person has 54 qualifying payment counts, you would subtract 54 from the 300 required, and it brings you to that total on the last line, which is forgiveness remaining payments. You would need to make an additional 246 payments in order to qualify for loan forgiveness. Now, again, that is specific to the IBR plan, to the ICR plan, excuse me. If you look at the screenshot below it with that yellow border, if you look at IBR, there's two different versions of IBR. There's older IBR, which is this top version, and then there's IBR 2014. The version of IBR that you qualify for depends on when you took out the loans. The older version of IBR is for loans from before 2014, July 2014. And the newer version of 2014 is for those with post-July 2014 loans. So in this case, this person, it has 0 qualifying payment counts in that top IBR because they do not qualify for that plan. So it's at 0. But if you look at IBR 2014, this person also has 54 payment counts towards IBR 2014. If you look at the second to last row, the forgiveness required payments, IBR 2014 only requires 240 versus the 300 required in ICR and the older version of IBR. So in this case, this person only needs to make an additional 186 payments to qualify for loan forgiveness on the IBR plan. When you go through this, each plan will have a different number of required payments. Just pay attention to that. And then you'll be able to determine where you are at in your repayment history. All right, so let's talk about the upcoming repayment changes, and that includes new repayment plans. So let's dive right in. So beginning July 1st, 2026, and this is really important, anyone who takes out a new loan or consolidates on or after July 1st will be subject to these limited repayment options. You will only have the new standard plan or the RAP plan, or the repayment assistance plan. Now let's talk about what those two plans are. So the new standard plan. This plan is specifically for borrowers who take out a new loan or consolidate on or after July 1st, 2026. If that's not you, this will not be an option available to you. So the new standard plan, it is based on a timeline of 10 to 25 years. If your balance is less than $25,000, your repayment term is 10 years. If your balance is between $25,000 and $50,000, your repayment term is 15 years. If it's between $50,000 and $100,000, it's 20 years, and anything upwards of $100,000 would be 25 years. Now, the new standard plan does not qualify for public service loan forgiveness. So that's one really important note here for folks. Parent Plus loans that are issued or consolidated on or after July 1st, 2026 will only have access to the new standard plan as their repayment option. There will not be any IDR or income-driven repayment options available to these Parent Plus folks, unfortunately. And then again, an important note is that if all of your loans are from before July 1st, 2026, but you take on or consolidate even just one loan after July 1st or on July 1st, 2026, you will lose all access to income-driven repayment plans. Specifically for Parent Plus loans, for folks that consolidate, you will only have access to the RAP plan. So what is RAP? RAP is the repayment assistance plan that is also slated to begin July 1st, 2026. This plan is even longer than the current repayment plans, that the term is 30 years, which is wild to think it's equivalent to a mortgage, and it requires 360 income-driven repayment credits. Now, who qualifies for RAP? All borrowers with direct loans qualify for RAP, with the exception of Parent Plus loans, unfortunately. Parent Plus loans do not have access to the RAP plan. Now, some other things that are important to note here is that $0 payments will no longer exist under the RAP plan. There will be a minimum of a $10 payment, even if you are unemployed. The RAP plan is somewhat similar to the SAVE plan in the sense that it does waive any interest not covered by the borrower's monthly payment and will reduce the borrower's principal by up to $50 if the payment does not. However, the calculation of RAP is different to the other repayment plans because it is going to be based on 1 to 10% of your adjusted gross income, which is a less generous calculation of income versus the discretionary income calculation for the other plans. It is less generous than SAVE and more expensive than other repayment plans for lower income folks. So if you take a look at this chart here, if you are making less than $10,000, your payment's going to be $10. If we look at a range of $50,000 to $60,000, it's going to look at 5% of your income, and your monthly payment will be somewhere between $208 to $250. However, if you look at an income between $90,000 and $100,000, it's going to look at 9% of your income, and your monthly payment is going to be anywhere from $675 to $750 on the RAP plan. And we do have some examples to go through here for folks to sort of visualize what this looks like. All right, so taking a look at some scenarios here for borrowers. So we're looking at Maya, who took out loans for grad school in 2021 and is now entering repayments. Maya has a household size of 4, so married with 2 kids. Her loan amount is $100,000 and the combined household income is $80,000. When we put in Maya's information into the calculators, this is what we see. On the new IBR plan, Maya would pay an estimated $264.79. The same amount applies to the pay plan, $264.79. Both of those payments plans are based on 20 years and 240 credits. If we look at her calculation for the RAP plan, which is based on 30 years and 360 credits, her monthly payment amount will be $366.67. Her calculation for the ICR plan, which is 25 years and 300 credits, is $797.50. And her payment on the standard plan, which would be based on 10 years and full payoff, no loan forgiveness, would be an estimated $1,161. So that is Maya. Now, the following scenario here, we have Adriana. Adriana took out loans and entered into repayment in 2013. Her household size is 2. She's married with no kids. Her loan amount is $60,000, and her combined household income is $40,000. Under the pay plan, her monthly payment would be $68.96. On the RAP plan, it would be $100. She took out loans in 2013, so her monthly payment amount is for the old IBR plan is $103.44. On the ICR plan, it is $300 and 314 and 17 cents. And on the standard plan, it would be $678. Now, for the third scenario here, we have folks taking out on loans after July 1st, 2026. So Alexis plans to take out student loans in the spring of 2027. He has a household size of 4. He's married with 2 kids. His loan amount is $90,000 and a combined income of $150,000. His repayment options are going to be the new standard plan and the wrap plan. Those are the only 2 options available to him. In his case, his monthly payment amount on the new standard plan is going to be $697 over the course of 20 years. And unfortunately for him, the new standard plan is actually more affordable than the income-driven repayment option, which is wrap. That is based on 30 years and 360 credits. So the wrap payment, because of his income, is $1,250 on the wrap plan. It's not always the case that the standard plan is going to be more affordable than the wrap plan. That is just based on this calculation, but it's something that folks should be aware of as a possibility. And then we look at Josiah, who has Parent Plus loans. So Josiah has student loans of his own. However, he plans on taking out Parent Plus loans for his daughters to go to school in August 2026. He has a household size of 5. He's married with 3 kids. The loan amount that he took out is $60,000 and has a combined income of $105,000. His only option for repayment is the new standard plan. So his monthly payment is going to be $465.18. His repayment term is 20 years, which is based on his loan balance. Again, this is full loan payoff, no loan forgiveness, and no income-driven repayment option. So even if his income decreases for any reason, his monthly payment will be fixed at $465, which is, again, really, really frustrating for Parent Plus loans moving forward to lose that option, especially in a time when we know a lot of folks are struggling with their student loan payments. Okay, so that was a lot of information. So we do want to recap here for you exactly what to look ahead to in the coming months. So borrowers with only loans from before July 1st, 2026, if that's you and you don't plan to take out any more loans, this applies to you. So you will retain access to the old repayment system, meaning the standard plan, the fixed options, and the income-driven repayment options. If you have Parent Plus loans, you will need to consolidate your loans if they're not consolidated already to retain access to income-driven repayment plans. And then that recommended consolidation deadline, as Sabrina Ashley said earlier, is April 1st. And then one thing to keep in mind is that folks will have access to ICR and pay until they phase out July 1st, 2028 at the latest. Now, if you are a borrower with any new loans or consolidate on or after July 1st, 2026, you will only have access to the new standard plan and the wrap plan. And for Parent Plus folks, you will only have access to the new standard plan, not the wrap plan. All right, we are nearing the end. So I am going to kick it over to my colleague Angel to go over the last few slides, but thank you all for hanging on with us because this is a lot to go through.
Thank you so much, Sabrina. So let's go ahead and jump into additional forms of loan cancellation and discharge. So the first one we're going to go ahead and discuss, and I saw a lot of folks have questions about this in the chat, is Public Service Loan Forgiveness, PSLF. A quick overview of what PSLF is. It is a program that started on October 1st of 2007, and it forgives any remaining student loan balance after the borrower has made 120 cumulative payments, which is the equivalent of 10 years, and allows time for processing. Again, these payments are cumulative and not consecutive, and you have to be working for a qualifying employer, which we'll discuss in a bit. The whole point about the PSLF program is for you to be able to reap the maximum benefit, which is enrolling in an income-driven repayment plan and pursuing public service loan forgiveness, you get the most amount forgiven of your student loans. Another flag is that for public service loan forgiveness, you need to be working full-time employed for that qualifying employer for a weekly average of at least 30 hours, and contractors do not qualify for public service loan forgiveness. So let's go ahead and see what does qualify for public service loan forgiveness. So direct loans, all direct loans, direct subsidized, unsubsidized, graduate plus, parent plus, and consolidation are eligible for public service loan forgiveness. For the repayment plans, the 10-year standard plan, the income contingent repayment plan ICR, pay as you earn, pay, income based repayment IBR, and the repayment assistance plan RAP do qualify for public service loan forgiveness. For employers, what is a qualifying employer? It is all levels of government, tribal, federal, state, local, 501(c)(3) nonprofits, and other critical public service, such as law enforcement, firefighters, and first responders. Now, what are other ways to go ahead and get your loans forgiven and discharged? So there is one that is called total and permanent disability discharge, which allows you to get full forgiveness on your federal student loans if you become totally or permanently disabled. Borrowers do need to provide documentation from the VA, the Veterans Affairs Office, Social Security Administration, or a medical professional. Other forms of loan forgiveness and discharge include borrower defense to repayment, false certification, unpaid refund, teacher loan forgiveness, closed school discharge, death discharge, and Perkins loan forgiveness. Now, the million-dollar question that a lot of folks have been asking, what can you do right now? What we recommend is that you make sure you have access to your studentaid.gov and loan servicer accounts. These are really important for you to get the most up-to-date information regarding your student loans. If you are a Parent Plus loan holder, you need to consider whether you need or want to consolidate your loans. And if you do, you have to apply by April 1st as the recommended deadline to ensure your consolidation application gets processed in time. And most importantly, save any form of documentation or communication you receive from your servicer, including that about income-driven repayment plan and public service loan forgiveness credits. So that can include screenshots, downloading, taking a picture, printing, whatever you need to do to document that information. Another thing is you have to be mindful that unfortunately there are debt relief scams. Scams usually involve something around the lines of offering loan consolidation or debt forgiveness in exchange for a fee. You should not have to pay for these processes or applications. Also, entities pretending to claim to be the Department of Education or promising immediate loan forgiveness, or also using bait and switch urgent language such as immediate loan forgiveness. Another thing to be mindful of, if you do decide to refinance your student loans with a private lender, you will lose access to all the aforementioned federal student loan benefits and programs. So that's just something to keep in mind that you will have lost access to that if you do decide to refinance. If you do run into any issues or complaints regarding your student loans, servicer, or anything related to student loans, you could go ahead and submit them to your representative's office. If our team could go ahead and please share the casework tool in the chat, that would be greatly appreciated. And of course, you could also submit your complaints and questions to State Attorney General's offices, your local or state student ombudsperson, of course, your servicer website. Some servicers have a chat and messaging feature. You can give them a call or email them, and the Department of Education's Help Center, which you could reach at that link. Now, we invite you all to please go ahead and join us for our upcoming events. Next week, we have our State of Student Debt Summit on Tuesday. It will be from 12:30 p.m. Eastern to 2:30 p.m. Eastern. So we invite you to join us and a lot of special guests as we'll be covering a variety of topics. Thank you to Sabrina Ashley for dropping the link in the chat so you could RSVP there. We'll have the latest federal updates, especially that to the SAVE plan, public service loan forgiveness, the student loan overhaul that's incoming, default, and more. And most importantly, we're going to be dedicating a significant portion of our programming to Q&A. So bring your questions, bring a friend, and we hope to see you there at our State of Student Debt Summit. And this is not some shameless promo, but if you would like to continue to get these updates, please join our mailing list. You could go ahead and join our mailing list at our website, studentdebtcrisis.org. You can also follow us on social media at debtcrisis.org on Twitter, Instagram, Facebook, and Blue Sky to get the latest updates pertaining to your student loans. And with that, I'll go ahead and pass it on to Sabrina Calazans to close us off.
Thank you, Angel, and thank you all for sticking with us as we covered a lot of information today. As we said, we're going to be sending around an email about 24 hours from now with a recording as well as all of the links that we've been sharing here for you all. I know that there are a lot of unanswered questions in the Q&A, so if you do have questions, feel free to email us. You can go to our website and submit questions there as well. We really appreciate you taking the time here. We hope to see you at our State of Student Debt Summit next week. But I hope everyone has a great rest of their day, and a huge thank you to our team for taking the time to be here as well. Thank you all so much and have a great rest of your day. Take care.